Debits and credits, simplified. Revenue increases equity, shown by rising bars. In accounting, every transaction has two sides, a debit and a credit. Think of it as a balancing act. The equation must always remain balanced. Debit means receiving value, and credit means giving value. When the owner brings cash into the business, cash is debited and capital is credited. Expenses like rent are always debited. Remember, every debit has an equal credit. In accounting, there are three types of accounts: personal, real, and nominal. For real accounts, debit what comes in and credit what goes out. For nominal accounts, debit expenses and credit income. Person is personal, asset is real, expense and income are nominal. Just remember this simple trick to master accounting basics. A journal entry is the first step in accounting. We record the transaction by debiting and crediting the appropriate accounts. Every journal entry has one debit and one credit of equal amount. Expenses are debited and cash or bank is credited.